Okay, so welcome back to another episode of Tion Talks. And today we have Rick Rule here. If you don't know him, he was the former president and CEO of Sprott US Holdings. And he was working in the investment management industry for over, is it 45 years?
Embarrassingly, yes, Tian.
Yeah, it's kind of scary to even think how long that is. That's a long time. So you must have a lot of experience in the whole, resource investing.
I've had the good fortune, I think. Well, first of all, I've had the good fortune to live a long time. Getting old beats the alternatives. But I've also focused on one thing my entire adult life. Other people perhaps led more interesting lives. But one thing that happens in terms of focusing on something when you're young and sticking with it for a very long time is you either come to know it fairly well or you fail. And mercifully, I haven't failed. I think it's fair to say that I've come to know the investing space and to a lesser degree, the conventional financial services investing space fairly well in 45 years.
Okay. And, whenever I look at you online in your interviews or whatever videos, I think of gold. I think of precious metals. Maybe that's because you're working at Sprott for so long. I don't know why. Maybe it's because you talk about it all the time. And so I want to get your opinions on, inflation, precious metals, and all of this. Starting with this, and we just got the CPI data for April, 4.2%, I think it was. And what's interesting is gold actually closed slightly down, and so I want to first get your reasoning for why that happened.
Let me disclaim first of all that I'm a credit analyst. I'm not an economist, and the further that you get me away from investment analysis, the more dangerous the ground that we're both on becomes. But since you've asked me, I'll attempt to answer. I would say, first of all, that the response to policy initiatives in the economy isn't as immediate as many people believe it is. There can be delayed reactions as the consequences of policy action becomes, first of all, more apparent, and also as the correct investing response becomes more apparent over time. I've now witnessed two prior gold bull markets, the 1970 to 1981 bull market and the 2000 to 2011 bull market. And I can tell you that while there are many things that drive demand for precious metals, what was most important in those two markets was either the reality or the perception that there was going to be a deterioration in the purchasing power of savings denominated in conventional fiat instruments, in particularly as expressed by declining nominal and negative real interest rates. And that set of circumstances is in front of us today. As an investment analyst, as an example, not an economist, and I look at the US 10-year Treasury, I see what Franz Pick described as a certificate of guaranteed confiscation. The government, for the first time perhaps in your life, Tian, is telling you the truth. They promise that if you give them money today, they'll give you back less in 10 years. Admirable honesty, but not attractive from an investment viewpoint. They promise to pay you 175 basis points in a currency where the purchasing power is depreciating by 460 basis points. In other words, they almost guarantee you a 300 basis point loss annually. Losing 3% annually, compounded over 10 years, is extraordinarily unpleasant. And yet people conditioned by a 40-year bull market in bonds stand in line to lose money on a guaranteed basis. Jim Grant goes so far as to call the US 10-year Treasury return-free risk. So gold is competing today with return-free risk, a war that I believe it can win.
Yeah, I've heard him talk about that. And so, if we get higher inflation, and if we also get higher interest rates, on the 10-year Treasury, for example, if we get higher inflation and higher interest rates, but let's say the real interest rate is at the same level, what do you think that would be?
Well, we saw that in the 1970s, of course. At the beginning of the decade of the 1970s, the US 10-year Treasury rate was about 3%. At the end, it was 15%. And the gold price rose because the US 10-year Treasury rate was a nominal rate, not a real rate. If you're getting paid 15% in a currency that's depreciating at 18% compounded, you still have a negative real rate of interest. It's important that people understand that. People your generation, and in fact, perhaps even your parents' generation, haven't experienced stagflation in the past. And it's very, very unpleasant. The circumstance that gives rise to an increase in gold and to a lesser extent silver prices is almost invariably unpleasant. So often when I give these interviews, particularly to younger people like yourself, I hope sincerely that the set of circumstances that I'm describing, my reasons for owning gold, doesn't come true. I think they're going to come true, but that's a different discussion.
Okay, so then what do you think the safest assets or safest asset classes or the most undervalued would be today?
I don't know that there are any. I think that you need to own cash, despite the fact that your purchasing power declines. You need to own cash because you need to have liquidity. A circumstance where an anomalous event, a so-called black swan, occurs, and we're overdue for one, is a circumstance where you see a contraction in trust and hence a credit contraction, and that causes you to see declines in asset prices. If you have liquidity when those about you don't, you can take advantage of the circumstance as opposed to be taken advantage of. So maintaining decent liquidity, maintaining decent cash balances, even knowing that the purchasing power of your cash declines, is important, because I'm not saying that we will, but if we have a decline similar to the decline that we enjoyed, if that's the right word, in 2008, having cash gives you the tools and perhaps the courage to take advantage of it as opposed to being taken advantage of. I suggest too that you want to own gold, which I consider to be good, if volatile, cash. It's a wonderful form of liquidity, and a form of liquidity that I think is more likely than not to maintain its purchasing power rather than to have its purchasing power deteriorate. You have correctly pointed out, I think, that it, from this base, wouldn't be unlikely to see interest rates increase. But what one wonders how much interest rates could increase before the economy lost its stimulated related steam, and before the increase in interest rates worked its way through the rest of the economy, impacting, as an example, voters and hence politicians. Think, as an example, if the increase in the US 10-year rate from 60 basis points to 175 basis points, which we've witnessed, works its way through the rest of the economy. Suppose that the 30-year fixed mortgage rate goes up by 125 basis points. What would that do to sales of existing homes or new home sales? Suppose that the proportional increase that we've seen in the US 10-year Treasury worked its way through to consumer debt, credit cards, or auto loans. How would the consumer economy, the debt-fueled economy, weather that storm? And if there was a slowdown, would those interest rates stick? I think that's the question that younger investors in particular need to ask themselves as a consequence of witnessing the political economy for 45 years. I suspect I already know the answer.
Yeah, and you were talking about cash. And, I kind of see cash as a form of, a form of insurance. And you kind of have to pay a premium on it every year. And apparently this month it was like 0.08%, or wait, 0.8%. And you also talk about holding gold. But for gold, are you talking about the physical or the gold mining companies?
For the liquidity portion of your portfolio, I would suggest that you either own physical gold or a very high quality proxy for physical gold. My preference, of course, would be that you held the Sprott Physical Gold Trust for fairly obvious reasons. I'm the largest shareholder of Sprott, and I get a fractional management fee from your doing so. But the truth is, from a portfolio point of view, my preferences are irrelevant. Own physical gold or own a high quality proxy. Pray it doesn't go up in price, and understand it's good but volatile liquidity. The gold mining shares one owns either as an investment, depending on the quality of the shares, or as a speculation, also depending on the quality of the shares. I happen to believe that there are very few undervalued asset classes in the world, and I believe that the mid-cap gold producers represent not merely a comparatively undervalued, but an absolutely undervalued asset class, which is rare in today's circumstance. I believe the junior miners are an overvalued asset class, although I believe they might go higher. And I believe that the senior gold miners are a fairly priced asset class. Given that my own outlook for the gold price is bullish, despite the fact that the seniors are fairly as opposed to undervalued, I advocate most people owning them because I think it's more likely than not that the gold price increases, which would, of course, increase the valuations that I was willing to pay for those senior producers.
Okay, so then what about kind of a more speculative, I guess, investment, silver?
I think you've put your finger on it. Silver has been viewed as the poor man's gold. More speculative. If the gold bug is crazy, the silver bug is manic depressive. And silver seems to be a mid-cycle and late cycle performer, which is to say that in precious metals bull markets, the market is led by gold because the first buyer is the fear buyer. When gold has established momentum in the middle part of a bull market or the later part of a bull market, silver traditionally has moved further and faster than gold. In my experience, Tian, and I'm not pretending to look back thousands of years, but rather 45 years, in the two bull markets, precious metals bull markets that I've experienced, they are longer in duration than most people suspect. They are 10 or 11 year, phenomenon. And their dimension is greater than people expect too. My belief is that we're probably, 3.5, 4 years into a precious metals bull market. And this is precisely the time in the middle part of the market where silver figuratively begins to shine. I should mention too, that if you study these precious metals bull markets, as I suspect that you will, what you will see is that the current malaise is common. That you can have cyclical declines in secular bull markets that are fairly long lasting, unnerving if you haven't been through them before you, and even breathtaking. I remember in my own formative years, in the first bull market I experienced, the 1970 to 1981 bull market, two things stood out. One, in the middle of that secular bull market, 1975, the gold price had increased sixfold between 1970 and 1975, only to see it fall by half in 1975. Many people who were gold adherents after a sixfold rise got shaken out by that 50% decline and missed a move from $100 an ounce to $850 an ounce in the final 5 years of that market. The malaise that we're seeing, in fact, the decline that we've seen in the gold price and the gold equities prices in this gold bull market is normal. The second thing is that it wasn't really until gold regained its luster, pardon the pun, in the 1975-76 period, that silver began to move. Gold moved first, silver moved later. But when silver moved, boy, did it move. It moved from $1.50 to $5 in the period, if my memory serves me well, in the period 1970 to 1975, and then from $5 to 50 in the 1975 to 1981 period. Will past be prologue? I don't know, but my suspicion is that silver will outpace gold, perhaps beginning as early as 18 months from now.
Okay, so then do you think if someone wanted to invest in gold and silver, do you think they should first get into gold and then try to jump into silver? Or do you think they should just go in owning both?
It depends on how you define the word invest, Tian. I believe speculate is a different circumstance. Speculating involves using money that one can afford to lose if one is wrong in terms of probabilities and possibilities. The most volatile asset class in the sector that I know of to the upside are the silver stocks. The market capitalization in the silver stocks is insufficient to hold the flow of generalist funds when they come into the silver market. There simply isn't sufficient market capitalization to contain the cash that wants to come in the silver market when the silver market begins to run. I remember in the 2000 to 2011 bull market, or earlier in the mini markets in the 1990s, silver equities advancing like Silver Standard did from 72 cents to $45, or Pan American from 50 cents to $45. Or in the earlier market, the 1970 markets, the granddaddy Coeur d'Alene going from 10 cents to $65. These are truly astonishing moves. But the silver stocks are incredibly volatile to the upside. It's important when people get their imaginations fired by those very strange stories that they understand that not all the junior silver stocks succeeded, which is to say there were many newly minted silver companies that didn't have any silver. And the consequence of having silver as a name on the share certificate without having any silver in the company's coffers means that while good things happened to the silver market, no good came to those shareholders of the pretend silver companies. And past will be prologue in that regard, I promise you. So to the extent that people speculate in the silver narrative, they still need to exhibit common sense and do due diligence on the silver stocks that they buy.
Yeah, and so as for something like silver, for example, or some other type of metal that there's a lot of companies who don't have the metals. Would you say that the royalty streaming ones are a better risk to reward, I guess you would put it?
Relatively, yes, absolutely. That isn't to say that there aren't some horrifically overvalued royalty and streaming companies now. But the royalty and streaming model is a better model than the normal Explorco model. The fact that it's a normal model means that the probability of success is higher, but it means something else too. It means that smarter management teams are attracted to it. Better people involved in a better model is better than dumber people involved in a less good model. So I would expect that while the royalty and streaming companies have perhaps less upside to offer, if you juxtapose the upside to the downside, the expected rates of return relative to the risk are much greater with the royalty and streaming sector than with the junior miners or the mining sector as a whole.
Okay, and you know, for the more speculative, I guess, metals, you know, I've always heard you talk about the uranium.
Uranium has treated me, as you know, very well. I'm also a determined contrarian. And the beauty of uranium there is that when it's out of favor, it doesn't just bore people. They hate it. When I started talking about uranium in 1998, 1999, there hadn't been a bull market in uranium since 3 Mile Island in 1982. So the sector had been out of favor for 16 years. Nobody had made any money for 16 years. Most people were bored by it. Some people didn't like it because they'd lost money in it, but a surprising number of people hated it. When I would talk at investment conferences about uranium, people would criticize me from the floor of the conference as being a profiteer on Hiroshima, Nagasaki, Chernobyl, and 3 Mile Island. It wasn't just that they were bored by it, they hated it. And there's nothing that contrarians like as much as hate. The idea of a contrarian is to buy into an asset class with no competition. And boy, that was there in spades. What's interesting there is that some of the people who criticized me so vociferously for being interested in uranium in 1999 were in 2006, the top of the bull market in uranium, soliciting my advice on uranium stocks, which is to say that their greed overwhelmed their misinformed morality, something that I found deliciously ironic.
Yeah, and I've also heard you talk about how the all-in cost of producing uranium is higher than the spot price. But I was always curious for why it took, or at least it takes so long for, I guess you could call it uranium's fundamental price to come into the spot market. Because if you take oil, for example, it was trading very low, and the price came back up relatively quickly, at least compared to uranium. And so for uranium, why does it take so long in the spot market for uranium to come to its like a more sustainable price?
That's a wonderful question. I hope you have patience for a very long answer.
Okay.
Yeah, have a nap. In the first instance, a lot of oil gets used, depending on the economic circumstance, between 70 million and 100 million barrels a day gets used. Not very much uranium gets used, and uranium stores relatively well. It has a high price relative to its weight and volume, which is to say that a pound of uranium takes up substantially less room than a barrel of oil. Uranium stores well, and oil, because of its size, doesn't store well. I know that some of your people are going to say uranium doesn't store well at all. When you store it, it kills people. Those are people without a very good engineering background. Uranium, too, has greater utility as a generator of electricity than anything else, which is to say that a pound of uranium generates a lot more electricity than any similar weight or volume of material known to mankind. So it has strategic importance. The Japanese, as an example, after the 1970s oil embargo, decided as a matter of energy security that they needed a nuclear stockpile because you could store enough uranium in a fairly small building to power Japan Inc. for an extended period of time. You couldn't store that much natural gas or coal. So that's important. In terms of impacting supply, when we get short of uranium, it takes an extraordinarily long time to discover, permit, and build a uranium mine. I don't know what part of the United States that you live in, or even if you live in the United States.
I'm in Canada.
Okay, so what part of Canada?
I'm in Windsor, Ontario. It's kind of close to.
Great. So let's assume, just for fun, that up in the Canadian Shield at Kappes Casing or someplace like that somebody made a uranium discovery. Unlikely, but let's just say it was so. What do you think the near-term probability of permitting a uranium discovery in Ontario would be? And how long do you think it would take to put it in production? My suspicion is that from discovery to production, if it was allowed to occur at all, would take 20 or 30 years. The idea that you can deal with a near-term shortage in uranium of the type that we encountered in the 2001 to 2000 timeframe with a new discovery that takes 30 years to put in production is nonsense. Similarly, if you build a uranium mine and you've spent $1 billion or $2 billion to build it, You have a cash cost of extracting uranium at $25 a pound. At $60, you're a happy guy. You produce it. Remember that you're $1.5 billion into this. At $50, you're a less happy guy, but you produce it. At 40, you're becoming unhappy, but you still produce it because you need to generate cash to pay down the bill, to pay down the loan. At 35, you produce it too, because you have hot decommissioning costs to shut the mine down. At $30, you produce it because you want to win the last man standing contest. In other words, you want to be still operating when your competitors have shut down so that you catch the rebound. And you may even produce it at $20 a pound because you want to get paid your salary, irrespective of what happened to the shareholders. So bull markets tend to persist longer than they should to the upside, and bear markets tend to persist longer than they should to the downside, simply because of the capital-intensive cyclical nature of the commodity. The second thing is that you can turn off uranium demand temporarily, very dramatically. The shutdown of the nuclear fleet in Japan proves that. Japan was consuming about 40 million pounds of uranium prior to the tragic events at Fukushima. The shutdown of the Japanese nuclear fleet, I'm sorry, 40 plants. I gave you the wrong number in terms of consumption, more like 15 or 16 million pounds. That went to zero. The consequence of that is that the price of seaborne liquefied natural gas went from something like $4 per million BTU to $17 per million BTU. A penalty that the Japanese economy could sustain for some period of time, but it's becoming increasingly costly. So for all of those reasons, the imbalances between supply and demand in all cyclical capital-intensive markets, but particularly with regards to uranium, can become exaggerated.
Yeah, so I for uranium, I see that there's a lot more of the practical reasons. And so it's kind of the, see, I would put it as a micro reason, like a reason of the sector that the sector faces. But for, something like precious metals, I see that more of a macro reason. But do you think that there are micro reasons for the whole precious metals industry as well? So like, discovery shortages?
No. A lot of people point to that. But the truth is that almost all the gold that's ever been found is still supply. Yes, we use some up in, microelectronics. Yes, we add value to it, allegedly at least, in religious iconography and jewelry. But the truth is that most of the gold that's ever been mined is still supply. In fact, we do a silly thing. We take it out of a hole in the ground called a mine, put it in a hole in the ground called a vault, allegedly beneficiating it in the process. But irony aside, new mine supply probably adds 1% or 1.5% to above ground supplies of gold on an annual basis. What's much more important in the gold sector is demand and the nature of demand. Silver is a little different because about 1 billion ounces of silver goes to silver heaven every year, which is to say it's used up in non-recyclable applications, germicides, reflective properties as an example for solar energy installations, microelectronics. So in that circumstance, both supply and demand, and the nature of the demand, whether it's industrial demand, fabrication demand, or investment demand, becomes very relevant. But with regards to gold, I would suggest that it's much less the micro factors having to do with the discovery cycle or the production cycle, and much more to do with demand.
Yeah, and I've also heard you talk about somewhere that the ownership of gold and the gold companies and whatever is, it's very historically low.
It is.
And so, I mean, is there a practical reason for that? So, for example, there's a lot more types of assets to own, or is it just because it's underlooked?
I think we've lived through the most benign economic period in the history of mankind since 1981. We started with interest rates very high, and we finished with interest rates very low. Declining interest rates are a wonderful soporific for whatever other problems we might have. But it's been a benign period too, despite the fact that we've had some challenges. The world is much more peaceful than it's ever been, certainly more peaceful than it was in the 1970s. And until very recently, the growth in the rate of government, which is to say the growth in coercion, the growth in consumption has been tempered relative to economic output at the same time that there was a growth in world trade. And finally, the ascent of humankind. The best example, of course, would be the ascent of China, post Deng Xiaoping saying to be rich is glorious, meant that the circumstance that we've existed in the period 1982 to 2022 has been the most benign economic period in the history of mankind. And so the need for owning a medium of exchange that was simultaneously a store of value, that is the need for gold, an asset class that does well during periods of low social trust, has been smaller. We haven't needed gold as much. My suspicion is that we're moving out of this benign period now. There is a growth in the belief worldwide in collective strategies, which is to say that individual initiative will be hard pressed to finance collective stupidity going forward. There are collisions in cultures, not just the Sino-American collision, but really a return to economic nationalism and a retreat from world trade on a historic basis. The bright spot, I think, is the continued growth in technology, which means that our individual initiative may still be able to fund our collective stupidity. And at the risk of sounding politically correct, the other thing that, something I'm not normally accused of, the other thing that gives me hope is a growing tendency towards inclusion. The idea, as an example, that women would be excluded from solutions suggests that we're rich enough to ignore the impact of the IQ of 50% of humankind, which is extremely stupid. The idea, too, that the economy should be run by old, fat, bald white guys that look like me, as opposed to young, smart Asian guys that look like you, is really, really, really stupid math. And one thing that makes me feel a lot better about the next 20 years is the fact that perhaps for the wrong reasons, we've come to the right conclusion, which is to say that we've decided to give the franchise to more people around the world in terms of the advance of humankind. But that was a long-winded commercial. Really, I believe that we're coming out of a benign period and into a less benign period. And that, unfortunately, while it's bad for humankind, is good for gold.
And so with that, in a lot of less developed countries, I suppose that, we're going to get a lot more infrastructure building as well.
We are. I think that's inevitable, and I think it's great. One of the things that you see in your country, Canada, and I see in the United States is a discussion, as an example, of the so-called electric metals. And we, in a very ethnocentric sense, think that that's due to $90,000 Tesla cars, to the electric vehicle. That's silly. What it has to do with is 1.2 billion people on Earth that don't have access to electricity, including still 150 million of them in China. The ascent of humankind, the increasing living standards among the 2 billion of the poorest of the poor, and the increasing utilization of electricity in the global middle class, including electric vehicles, but not predominantly electric vehicles, is what's going to drive that sector of the economy. And it isn't just the cable to connect to the 1.2 billion people that doesn't have electricity. It's what they do with the power when they get it. electrifying their cars, changing the living standards, very much the way the living standards in China changed, from rural to urban, from barefoot to shoes, from shoes to bicycles, from bicycles to 50cc motorcycles, from 50cc motorcycles to Toyota Hiluxes, not Teslas, from thatch huts to cinder blocks, from thatch roofs to steel roofs. The ascent of man is what's going to drive commodities demand on a global basis.
Okay, so which, I guess, industrial metals do you think are going to benefit the most from this?
I'm embarrassed to say that the industrial metals are all benefiting much sooner than I thought they would. I would have thought that the recovery from the COVID shock would have taken much longer than it would. So mercifully for me, I'm wrong. I thought that we'd see today's copper prices in 2025. I would say that the surest increase, although the equities are currently overpriced, would be in uranium. It costs $55, $60 to make, it sells for 30. The price goes up or the lights go out. It's that simple. Had you asked me the question a year ago, I would have said that it was a no-brainer. It was oil and gas. The oil price at $60 WTI doesn't need to go higher, although I believe it will go higher. I think for Canadians, the easiest resource equities to buy in the next 2 or 3 years to make money would be the mid-cap Canadian oil and gas companies. The fact that your oil and gas companies exist is testimony to the prolific nature of the Western Canadian Sedimentary Basin and the ingenuity of the industry. The idea that the most important industry in terms of financial contribution to Canada can exist with the overt hostility of your political class is amazing to me. I mean, really, truly amazing to me. Talk about snatching defeat from the jaws of victory. But that notwithstanding, the industry has survived and to a certain extent thrived despite the idiocy of your political class. And I think that the wind is really, truly in Calgary's sails in the next 3 years. And I would urge young people, despite the fact that neither your prime minister nor Ms. Thornburg think there's a future for oil, to understand that it's the easiest investing class in Canada to make money on the next 3 years. Maybe not the most rewarding, but the best juxtaposition of risk to reward.
Yeah, and with all of these policies, trying to shift to green and trying to be more environmental, and with all these new regulations and rules, how do you think that's going to impact the whole way you invest in resources?
I suspect that we'll, as a consequence of technology and carbon, that we will phase out oil. I suspect, my best guess is that peak oil demand occurs in 2040. Meanwhile, for the next 18 years, we have to produce it. And we have to produce it with very high sustaining capital expenditures, which we're not making. If you have a circumstance where the demand is there, Greta notwithstanding, and you don't have the supply, the price goes up. It's ironic to me that the Trudeau fortune, as an example, comes from filling stations. Young Mr. Trudeau has been a beneficiary of the fortune. He wasn't involved in making it. And one would suggest that his grasp of narrative is better than his grasp of arithmetic. The irony will be that the Trudeau family fortunes will remain intact despite the best efforts of this latest generation to destroy them, simply because oil and gas are such efficient generators of energy. It's interesting, too, that when one looks at the signatories, the developed country signatories to the Paris Climate Accords, the best country in terms of reduction of carbon emissions was a non-signatory, the United States, because of the wholesale shift in the United States from coal-generated power to natural gas. This talks a lot about the fact that the political class and many of the chattering classes, be it the cabal of Babel in the press or academia, rely on narrative as opposed to engineering or arithmetic. to figure out how humankind is going to navigate the shift to a lower carbon environment. First of all, it's going to take a long time. It's going to cost a lot of money, and the shift will be powered by oil and gas.
Yeah, okay. And then what about some of the, because stuff like lithium and cobalt and nickel, that was quite popular with the whole electric vehicle. When that was really hyped up.
All important, very, very, very important. Understand that these businesses are going to grow, and they're going to grow from tiny, tiny, tiny bases, which is what makes them so important. But again, you have to separate the arithmetic from the narrative. Lithium, as an example. We don't have a lithium shortage in the world. We have a shortage of lithium production capacity. That is to say, processing capacity. SQM, which is, I think, the world's second largest lithium producer now, suggests that at current rates of demand, they're down to 85 years of reserves. They aren't looking for it because they have too much. What they don't have is a sufficient production capacity and sufficient processing capacity. I think the lithium business is going to be a superb business. And I think the people who are going to benefit from it are the people who are already established producers who debottleneck their capacity. It seems like the only people in the world who see a lithium shortage are those Canadian juniors who don't have any lithium. And I would suggest to you that their shortage is more personal than industry-wide. I suggest that there will be copper shortages, almost irrespective of what we do, not so much because of an increase in demand for copper, but rather because as a society, we have underinvested in copper exploration and copper development for 30 years. There's a wonderful deposit in the United States called Resolution, which was discovered about 15 years ago. It's over 1 billion tons of 1.5% copper. It's conveniently located next to a copper mine, good place for a copper mine. It probably will not be permitted for 10 years, if it ever gets permitted at all. It probably won't be built for 15 or 20 years, but we're going to need the copper in 5 years. Almost irrespective of what we do, we are living as a society on copper that was discovered in the 60s, 70s, and 80s, put in production in the 90s. These mines, be they Grasberg or be they Escondida, are long of tooth, and they will deplete before we have the ability to replace them. Similarly, in the nickel business, Sudbury, basically discovered by Thomas Edison. This thing has been kicking out nickel for 100 years. But you don't stand at the top of the Frobe shaft and throw in fertilizer and water and have it grow more nickel. You need to have been looking for this nickel and permitting this nickel for the last 30 years, and we haven't done it, almost irrespective of what we do, save absolutely destroying parts of Indonesia and the Philippines with lateritic nickel mining. There's not much we can do to avert a shortage. And cobalt, I see a great future for cobalt. But investing in cobalt means that you are comfortable investing in Congo, which I personally am, comfortable investing in Russia, which I personally am, and perhaps comfortable investing in Zimbabwe, which is a little more problematic for me. In other words, if you're going to play the cobalt thesis, there is no politically correct cobalt. It comes from places where the so-called green investor has moral challenges, and some other investors have practical challenges that go to the opacity and occasionally the violence of domestic politics where the stuff is produced.
And so which, metals do you think will face the worst shortage issues? Or any resources in general?
Water, I think, in your lifetime, will be the material, not the metal, the material that causes the most turmoil. To invest in water, you need to invest in rich places that can afford it and dry places. Your challenge in Canada is often to make the water go away. But there are other parts of the world that are somewhat less fortunate. And water has been allocated for many, many, many years politically rather than by markets, which means, ironically, that water has flowed uphill to votes rather than naturally downhill to utility or to markets. So we have circumstances, as an example, where I just left the People's Republic of California, where we use subsidized water to grow rice in the desert. If this sounds stupid, it's because it's stupid. And this artificial allocation of water is really going to come back to bite us. Might not happen for 10 years, but when it does, it'll take 50 years to fix. So if I was a patient young man and looking to invest in something that would certainly create benefits with risks, political risks over one's life, water is easily the most undervalued and most distorted commodity known to humankind.
So if I was traveling 10 years into the future, and if I wanted to invest in water, how would I do it?
The best way that I can think of, and there are risks, would be to buy the agricultural companies in the US West or the Southwest, or else to buy exchange traded water rights in the Darling Basin in Australia. The best free market in water in the world is in Australia right now, and you can actually buy a variety of securitized water rights. If you don't want to do that, there are a couple companies in California, one a very thinly traded company called Boswell, which owns a lot of water rights. It's a farming and land company, really. Another is called Limonera. The risk associated with this is that if water reprices, the amount of social envy that accompanies it will be spectacular. The pressure put on by the voters who were stupid to get even with investors and speculators who were smart will be extreme. In the worst circumstance, you'll be hung. In the middle circumstance, you'll merely be vilified. And in the best circumstance, you'll be rewarded for your vision and become very rich indeed.
And so you talked about how you could profit off of it by getting into agricultural companies. And how does that all work?
Water rights in California were apportioned by the legislature 100 years ago. And at that point in time, the biggest business in California was agriculture. So the farmers made sure that the legislature protected them from urban users of water. And they allocated most of the water rights in the state to agricultural uses and made a law that said that water couldn't be voided or changed from rural uses to urban uses. So 85% of the water in the state of California goes to generate 2.5% of the state GDP. But at some point in time, when water truly becomes scarce in California, and when the landscaping around all the houses of the Cadillac communists in West Los Angeles begins to wilt, it might be that a free market in water develops. The truth is that the utility of water for brushing teeth, flushing toilets, and watering roses is higher than the utility of growing rice or alfalfa in the desert. And when California actually runs out of water, there will be a reckoning. And I use California as a metaphor. Colorado, Nevada, Arizona, New Mexico, Texas, the whole US West and Southwest is, first of all, mining water, depleting the Ogallala Aquifer, the massive and wonderful basin that supplies Western agriculture at an alarming rate, well beyond recharge, but also allocating water not based on utility, but rather based on votes. And that'll have to change. One example would be the Colorado River. The Colorado River was apportioned by the US Army Corps of Engineers in the 19-teens. Unbeknownst to them, they apportioned the river during a period of historically high flows. And so they've apportioned about 115% of the flow of the river. Using 115% of the flow of the river is, of course, very, very difficult for the river. And this will ultimately have consequences. I don't know what they'll be.
Do you think the whole water thing will be kind of contained in those areas? Because it's kind of hard to see how you could just internationally trade water?
Water's cheap. It doesn't store well. It doesn't transport well. And also in Canada, it's a measure of sovereignty. I remember many years ago being on BNN in Canada talking about water as a resource. In those days, the BNN studios overlooked the lake in Toronto. And I said jokingly as an American, that I didn't think anybody'd missed the top couple of meters of the lake. And BNN told me that they got the most inbound calls they had ever gotten as a consequence of that result. None of them friendly, of course. I remarked that in Canada, water seemed to involve sovereignty, where canola, that is to say rapeseed, auto parts, things like that didn't involve sovereignty. So there are political issues around water too that limit its transferability and make the inevitable disruption in water markets even more remarkable than it's going to be. It's important to note too that economic returns from water won't accrue to need. As an example, investing in water in Somalia or Eritrea or northern Pakistan or Afghanistan, despite the fact that they're going to need water, isn't going to matter because they can't afford to pay for it. You're going to have to obtain supplies of water in places where water is scarce, not British Columbia, and places that are rich. So places like Chile, places like Australia, places like the US Southwest, places perhaps like Spain.
Yeah, okay. That the whole water issue sounds quite interesting. And how long do you think it's going to take?
I have no idea. No idea. I mean, one of the interesting things that happens as you get older is that despite the fact that you have less time in front of you on Earth, you become more patient because you understand that your time preference is irrelevant. The fact that you want something to happen over a long weekend doesn't matter to the cosmos at all. And investing themes take time to play out. The fact that that time is inconvenient to speculators is interesting, but not relevant.
Okay, so we are kind of short on time, but I still have a lot of questions I want to ask you. So I want to kind of wrap this up by asking you, is there any time in history that kind of, well, okay, let me put it like this. So is there any time in history that today reminds you for the whole commodities and resource sector?
No. Probably the closest would be, I think, the early part of the 1970s. But I don't think that the response will be as dramatic as that response was. We had been through a longer bear market in resources, a bear market that went back to the beginnings of the Depression in the late 1920s, a bear market in resources, a period of underinvestment in resources that went from, say, 1928 all the way to 1970. One that was also punctuated by some extreme resource utilization in World War II, as an example, and the economic recovery in the 50s and 60s. We have been through an extractive industry bear market, if you will, from 2012 to 2020, but that's a fairly short bear market in historic terms. I think that the economic circumstance of the 1970s might be instructive, though, coming off a boom in the 50s and 60s, like we're coming off a 40-year boom that we've experienced now. A period that was devoid of fear, which the 50s and 60s certainly were. The reckoning of the 1970s, I think, was the antidote to the recklessness of the 50s and 60s. And in that regard, I think the period in front of us might be an example of past being prologue.
And I just remembered a question that I wanted to ask you, and that was about phosphates. Yeah.
I think a resurgence in phosphate and potash both, the whole agricultural minerals complex is a very, very investable theme. Whether it takes 5 years or 7 years is a different question. But I suspect that the Moroccans will figure out that trying to dominate the world phosphate market is less attractive than allowing the phosphate that they sell to generate the margin that it can sell. Similarly, I think the Russians will have the same experience with the potash. What you've seen in agricultural commodities has been a fight for market share, where the low-cost producers have tried to force the high-cost producers out of the market. At some point in time, when the prices get substantially below the global median cost of production, that turns out to be a very stupid strategy.
Okay, so I guess we'll end it there. I really want to thank you a lot for coming on today. And, I'd like to do this again in the future.
You know how to find me.
Yeah.
When my schedule permits, my schedule keeper is Callie Farnham, as you know. I'm happy to do it.
But yeah, are you still doing those ranking things? I've heard it too many times now, and I want to hear it again.
I'm happy to do that. And if your listeners who care about my opinion as to their resource portfolio can go to a website, sprottusa.com/rankings, list your natural resource portfolio. Please no pot stocks, please no tech stocks. I'll rank them 1 through 10, 1 being best, 10 being worst. And I'll comment on those issues where I think my comments might have value. Also, to the extent that your listeners are interested, if they mention the word charts in the subject line or the comments line, I'll include a copy of the Barron's Gold Mining Index, the longest running and most inclusive gold equities index that I know, and also a 100-year commodity chart that talks about many of the questions that we've talked about in the context of relative valuations of industrial materials relative to other asset classes going back 100 years.
Okay, well, thank you, and have a good one.
A pleasure. Thank you.
Bye.
Bye-bye.